My name is Peter Stanton, and I'm the publisher of the Worcester Business Journal. And on behalf of our team and our presenting sponsor, TD Bank, we welcome you to this, which is our second annual international business event. A year ago at this event, we had a fascinating conversation about doing business specifically in China. And this year, while China will certainly be in the mix, we'll be taking a broader look at some of the challenges and opportunities of doing business internationally in today's recovering but still very difficult economy. We're pleased to have a terrific keynote speaker in Shaun Osborne from TD Securities, followed by a panel conversation with Shaun, John Stowe of Lutco, Inc., Wayne Canty of Heat Trace Products, and that will be moderated by Worcester Business Journal editor Rick Saia. We should all be able to walk away from this morning with new insights, perspectives, and ideas that we can put to use, and I hope that you really enjoy the program and also are able to participate in it as well. This event, as I mentioned, is possible due to the support of our sponsors and partnering organizations. Our presenting sponsor, again, is TD Bank, and not only does TD Bank have logos. Look at them. They put their logo on all the microphones. Man, these guys are on top of their game. And our event partners are AIM International Business Council, the Massachusetts Export Center, and Mass MEP, which stands for the Manufacturing Extension Partnership. So a special thank you to TD Bank and our event partners who helped make this morning happen. Thank you all. First up, after my brief introduction here, after me I would like to invite up Rob Babcock. Rob is TD Bank's Market President for Central and Western Mass. Rob, would you come up for a few comments?
Thank you, Peter. You know, Worcester Business Journal is key for me. I read it yesterday. And I don't know what you've done differently, but I know it's different, and it's awesome. There's so many things to read, newspapers, on the internet, but I do rely on this one. I don't know what you've done, but thank you for doing it. Doing a nice job with it. Great turnout today. I was talking to Shaun Osborne as far as the size of these groups he talks to, and I think this is a much larger group. And as I reminded Shaun this morning, Worcester's still the second largest city in New England, which is awesome for all of us. Still a great manufacturing core. Certainly with all that manufacturing, a lot of foreign exchange needs, and TD's got a great foreign exchange team. Mike O'Hare, stand up. Mike runs New England for us. And Brian Lindquist. Brian, stand up, wave. Kind of a local guy. If you're not a TD foreign exchange customer, you're making a mistake. At this point in the world, there's only 5 banks that are left that have a AAA rating from S&P. We're one of them. And there's 3 banks left on the New York Stock Exchange that have a AAA rating, and we're one of them. And what a lot of people from TD Bank find interesting, and that's employees from Maine to Florida. And I think we've got about 75 different regions in the bank, from Portland, Maine to South Carolina to Miami. And those 75 different regions, there's not a bigger region as far as a commercial loan portfolio and the number of commercial lenders than Central Massachusetts. Just a big old base of, again, manufacturing, great companies. It's a big city, it's a big county. We've got a very nice customer base, and happy to be here today, and thanks for everybody for coming out.
Thank you, Rob. So it is my pleasure to be able to introduce Shaun Osborne. Shaun is the Chief FX. Sounds like it stands for, obviously, foreign exchange. Sounds like he's a bit of a secret agent. Chief FX Strategist for TD Securities, based out of Toronto, where, alas, the resident Blue Jays still hold a healthy lead over our last place Boston Red Sox. A pause there. Maybe we're coming back, though. Shaun provides fundamental and technically driven commentary, research, and trading strategies focused on major currencies for TD Securities and its clients. In the heat of the economic turmoil in 2008 and 2009, Thomson Reuters ranked TD Securities as third in 2008 and first in 2009 when measured up against 61 other banks. Bloomberg ranked TD Securities the most accurate currency forecaster in the world over an 18-month period through June of 2010, with the lowest margin of error out of 48 forecasters. So this man is very, very accurate. A member of the TD Securities team since 2006, Shaun has been a longtime currency strategist, working previously out of Toronto, London, and Paris, where he was a G7 currency analyst and economist. He is frequently quoted in the national and international media and makes regular television and radio appearances, sharing his views and insights on market developments. We're thrilled to have Shaun here as our guest and keynote speaker here this morning. So without further ado, Shaun Osborne.
Fairly quickly. I think I'm wearing the same shirt in that photograph there. That's a bit embarrassing. That's got to plan ahead. Thank you very much for coming along this morning. It's very nice to be here. I'm a transplanted Brit from Toronto, but I do have quite an interesting Worcester connection. My wife did her MBA BA at Clark University. So she made a couple of recommendations last night, but unfortunately we didn't quite get to Moynies or the Blarney Stone. Anyway, maybe that'll be for later on today. Thanks very much for coming along. Interesting you mentioned the Blue Jays. It's always a bit embarrassing traveling down to the States this time of year because I'm reminded that there is a term called post-season, which is something we're very unfamiliar with in Toronto, whether it's NBA, NHL, or pretty much anything else. Anyway, on to the subject at hand, hopefully. I'm going to talk a lot about Europe this morning and what's going on in Europe. It is really, I think, a big part of what's going on in the global economy. It's a big part of what's going on in the foreign exchange market. It has a big influence on what's going on with the US dollar. And so I'm going to be talking a lot about Europe and what we think is going on with the single currency there and the outlook for the euro. But just to kind of get us situated and oriented at the moment. Look at this chart. This shows just how much of a struggle it really has been to overcome that very big setback we had in the global economy in 2008, 2009. So what we've done here is just benchmark the various growth peaks, the GDP peaks for the various economies to the 100 point on the index, and then we're looking at just how quickly those economies have managed to win back all that output that was lost during the downturn. And you can see that. For North America, the US and Canada was right out of the gates in terms of the recovery, very quick recovery for the Canadian economy. The US is just about back to and just surpassing, in fact, the previous GDP peak. But for Europe, it is still very much a struggle. The Eurozone economy, generally speaking, is about a percentage point still below that previous GDP peak. And for those smaller economies, the peripheral economies, at the edge of the Eurozone, this is a mighty struggle. There is still a big gap in terms of lost output, some 10 percentage points. In terms of lost output, it's still to be recovered for those economies. So these economies are sucking wind mightily at the moment, and everything that's going on there suggests that it is going to be a struggle in terms of growth for those economies moving forward. Now, we haven't had too bad a run in the market since the end of last year, actually. When we look at equity returns up until just recently, the S&P index was up about 20% from the mid-December point last year. Generally speaking, risk assets, equities, and the riskier kind of commodity investments that people typically like when they're in a kind of pro-risk investing mood have actually done pretty well. And one of the reasons for that is that central banks around the world have been really keeping the pedal to the metal in terms of monetary policy. In terms of nominal interest rates in a lot of jurisdictions, we are at zero bound. We can't cut nominal rates below zero. So what central banks have had to do is push increasing amounts of liquidity into the system. And this chart illustrates just what's going on with four of the largest central banks in the world. I think in the States there's often a lot of criticism about the policies that the Federal Reserve has pursued in terms of its quantitative easing policies. But I think the Fed has done a pretty good job in very, very difficult circumstances. And in fact, the accusations that I think are leveled against the Fed are probably a little bit unfair. When we look at the size of the Fed's balance sheet relative to the size of the US economy, so the dark green line here, we can see that actually, relatively speaking, the Fed has been less aggressive in terms of its monetary expansion than many other central banks around the world. In fact, it's been the least aggressive of the four major banks we're looking at here: the Federal Reserve, the Bank of England, the European Central Bank in blue, and the Bank of Japan. They're in yellow. These central banks have been much, much more aggressive in terms of pushing liquidity into the system than the Federal Reserve has. So we're looking here in relative terms. This is the size of the central bank's balance sheets relative to the size of the economy. But even in nominal terms, the European Central Bank has been extremely aggressive in responding to the crisis in Europe. And its balance sheet is about $1 trillion larger in nominal terms than the Federal Reserve right now. And $1 billion here, a few $100 billion there, so we're talking about some pretty serious money. $1 trillion is an awful lot of money. And so I think, some of the accusations that have been leveled against the Fed, as I said, are a little bit unfair. I don't think the Fed is deliberately trying to debase the dollar or anything other than doing anything other than trying to get the economy going in very, very difficult circumstances. There's a couple of myths I want to dispel this morning, and this is one of the first ones, that the Federal Reserve has been extremely loose or too loose with monetary policy. I think the Fed has done, as I said, a pretty good job in very difficult circumstances, and other central banks around the world have been even more aggressive with their balance sheet, expanding the monetary base to try and respond to the crisis that we're seeing in these various economies. So we have seen a bit of a recovery. In terms of the potential rate of growth in the US economy, we're about where we think we would have been at this stage of the recovery. When we look at the potential rates of growth here, we're looking at the OECD, the Organization of Economic Cooperation and Development, estimates of potential rates of growth, so how quickly an economy can expand without creating too much inflation. The US there in the orange line, you can see, is about 2.5%. That's about where we're going to be growing over the next 18 months, we think. There's a pretty steady growth outlook for the US at the moment. There is still a lot of things that can go wrong, unfortunately. We'll talk about one of those things in a while. But all else being equal, we think the US can keep moving along here at about 2.5% growth. Not great, certainly not compared to the sort of pre-crisis levels of expansion that we did see in the US economy. But I think if I'd have been here a few years ago saying that, don't worry, by 2011, 2012, the US economy would be growing again at about 2.5%, we would have taken that as a win. So the US economy is growing about as quickly as it can at the moment. When we look at the potential rates of growth for the European economies, though, we can see that there is a relatively large discrepancy between where they could be growing and where they are growing right now. They're essentially borderline recession in many jurisdictions. We just had the most recent GDP numbers for the Eurozone. They're just about flatlining. We're actually forecasting negative 0.5% for the Eurozone overall this year, so a pretty shallow recession, but very slow growth and a very slow recovery into 2013, only about 1% growth for the Eurozone economy through that period. So it doesn't feel great. It certainly could be a lot better, but it certainly could be an awful lot worse for the economies in our neck of the woods, Canada and the US. We're moving along at about where we could grow. The forward-looking indicators for the Eurozone are actually pretty abysmal, even in the larger economies. We have just about skirted recession in the first quarter for the Eurozone, but when we look at the forward-looking indicators, these indicators are still pretty abysmal. So here we're looking at order inflow into the German manufacturing sector, the blue line there. You can see that tends to correlate quite well. It's a pretty good lead indicator for general GDP growth in the German economy. And that suggests that the German economy probably will be contracting at some point in the not-too-distant future. So we're looking at a recession in Europe's largest economy, in all likelihood, which will be reflected in the performance of the other economies in the Eurozone. And when we break down the German economy, moving on to the nub of the issue here, when we break down the components of growth in the German economy, we see that Germans really aren't consumers, unlike many other large Western, particularly Western developed economies. Consumption is a big part of the overall growth pattern. Consumption is not a big part of what Germany does. The Germans aren't consumers. They're quite conservative. They don't like inflation, quite austere in their general outlook. But what has been good for Germany recently has been trade. Trade has been a great boon for the German economy since the advent of the euro. So this looks an awful mess of a chart. And if I actually just highlight the issue I want to talk about here, and that's the contribution of trade to growth. Germany has done very, very well out of the euro. In fact, Germany has done extremely well. As we can see from this chart, there has been an increasing contribution from net trade to GDP growth over the last 10 or 12 years since the euro was introduced. And what this suggests, and what we think is the case, is that the euro has really kept the level of the Deutschmark. If it still had the Deutschmark would be an extremely expensive currency. It's often the game we play on the desk back in Toronto. Where would the Deutschmark be now if we still had it? It would probably be the strongest currency in the world without a shadow of a doubt. So the euro has actually kept German industry, German exporters, extremely competitive. It's depressed, if you like, artificially the exchange rate for Germany. And Germany, although it's sounding quite down on the prospects for some of these smaller European economies, eurozone economies, the potential threat to the eurozone is quite significant for Germany. A breakup of the eurozone would be a significant drag, I think, on German growth, because they have been one of the biggest, I would say probably the biggest net beneficiary of the eurozone in terms of GDP growth of any of the eurozone economies. So destabilizing the eurozone is something that the Germans don't want. They don't want to keep on shouldering the weaker European economies, the eurozone economies, but at the same time they don't want to give up this pretty significant growth advantage that they've wrought from the single currency. So Germany's exporting, has been exporting quite nicely. When we look again at the history of the last 10 years, in terms of trade balance, the balance of payment situation, we can see that actually Germany's moved from a kind of small balance of payment deficit prior to the introduction of the euro in 1999 to a pretty substantial current account surplus over the course of the last few years. At the same time, we see the balance of payments deficits in the smaller peripheral economies. We're not allowed to call them pigs anymore, so actually I had to call them the GIPs, the Greece, Irelands, Italy's, Portugal's and Spain. When we look at the total imbalance in those economies, we can see that actually the increasing balance of payments deficits in those countries has really mirrored what's been going on in Germany. So Germany's exporting cars, fridges, dishwashers, all those great things that Germany can still make and make very well. To these smaller economies that are really living beyond their means and consuming beyond their means in an environment where probably interest rates were a little bit too low for many of these economies. It's been very difficult for the European Central Bank to regulate monetary policy across the Eurozone in an appropriate way. They tend to set policy for the largest economy, and that means Germany, rather than the smallest economy. So we did see a period of time in the pre-crisis era where interest rates in Spain, for example, were net negative in real terms, and that encouraged a significant increase in consumption, a construction boom, and the housing bubble, essentially, that we're seeing in many of those jurisdictions now. So there is at the heart of this problem a competitive problem within the Eurozone, and although we talk about the fiscal aspects of what's been going on and the fiscal imbalances that we've seen develop, at the heart of this problem, there is a competitive issue within the Eurozone that is still to be resolved. We're talking about the fiscal problems, as I said, as the key driver of what's going on at the moment. When we look at the debt to GDP ratios of many of these economies, they are very, very significant. But it's important to, I don't know if I have a lightsaber here, I don't. But what I wanted to point out here is the Irish situation. The Irish debt to GDP ratio was one of the lowest, in fact the lowest of any of the developed economies prior to the crisis. Ireland didn't have a fiscal problem prior to 2007, 2008. It had a balance of payments problem, but it didn't have a fiscal problem. It had a debt-to-GDP ratio of about 22%, which is entirely sustainable for an economy such as Spain, very, very low by international standards. And you can see that Spain had a pretty low debt-to-GDP ratio. Portugal was fairly low as well, but creeping a little bit higher. Italy and Greece certainly did have very large and growing fiscal imbalances, but Ireland didn't. Ireland was actually a pretty healthy economy. You heard about the Celtic Tiger, low growth, low unemployment, strong housing sector, very strong banking system. And this illustrates really just how quickly things can change. Ireland's problem was that its banking system was over-leveraged to a housing sector that was extremely overvalued. And when the housing market started to collapse in 2007, 2008, the Irish government essentially had to buy the entirety of the banking system in Ireland. So its debt to GDP ratio went from 22% of GDP to 125% of GDP in the space of 2 or 3 years. And lo and behold, Ireland now has a pretty significant fiscal problem. It didn't have a fiscal problem before, but it does now. So this is the situation in those smaller peripheral economies. We can see that to a large extent we're talking about debt to GDP ratios in excess of 100% for most of these economies, not sustainable in any way, shape or form. And these economies are under pressure now to rein back debt and spending in a very significant way. We are starting to see, however, the limits of fiscal austerity come home to roost. We're talking about very significant levels of contraction in growth overall. There is a very significant multiplier effect, if you like, for that these economies are starting to realise for reduced government spending. For every dollar, if you like, that a government spends in terms of reduced spending, there is more than $1 less of activity that's generated in these economies. So the multiplier effect of reduced government spending is actually quite significant. And we can see that measured in or reflected in the unemployment rates. Unemployment rates in many of these economies rather is actually growing and growing quite rapidly. So we're approaching 25%, in excess of 20% for Greece, close to 25% for Portugal, and in the teens for many of the other economies there. When we look at the youth category, so the sub-25-year-old category here, this is catastrophic for these economies. 50% unemployment for the likes of Greece and Spain, in the 30s for Italy and Portugal, in the 20s for the French economy, and to a degree for the UK economy as well. Germany there in splendid isolation, around 8% in terms of its youth unemployment rate. But these are the voters of today and tomorrow, as we're increasingly seeing in Europe. There's a whole generation of people growing up here. We're not talking about a lost generation in the way that Japan has experienced. This is a generation with no prospect of growth whatsoever. If austerity, as is dictated to these countries by the Germans and the French and the IMF and the European Central Bank continues, there is no prospect of growth in any of these economies for any foreseeable point in the future. So 50% unemployment may become 60% unemployment. It's a tremendously jarring socio-economic challenge for these economies, and something that is a big challenge for the euro. The reason why countries joined the euro and people signed up for the euro 10 or 12 years or so ago was to avoid exactly this kind of situation. The quid pro quo was that we will give up sovereignty over monetary policy, we'll give up our own national currency in return for increased financial and economic stability. What we're actually seeing is that the euro has compounded some of these imbalances and problems, and is actually driving these economies into the ground. There is no prospect of growth in any of these economies if they continue with these austere policies to rein back budget imbalances. There is no prospect of growth in any of these economies anytime soon. And we're seeing that increasingly that's reflected in market confidence. When we look at long-term government bond rates for these economies, we're kind of at the danger levels for many of those economies. We kind of have a kind of graduated level of alerts, if you like, for our own way of just eyeballing the markets and trying to assess what's going on. 6% yields on long-term government debt is the kind of early warning. Things are not going too well here. 7% is the red kind of flashing light. We're tipping over the abyss. When we get to 10%, as we've seen with Greece and with Portugal, that's typically game over, and an indication that investors have no confidence in the market's ability or the government's ability to rein back debt. Ireland is a bit of an exception here. We have seen quite a significant pullback in rates over the last year or so, but Irish 10-year rates are still trading or yielding in excess of 7%. And as you can see, for Italy and Spain, over the past few months, these rates have been moving up quite significantly, trading now very close to 6%. So the markets are on alert here. We're very concerned about what's going on in these larger economies. We kind of term Spain and Italy the too big to bail and too big to fail economies. There is just too much debt in both of those economies for any support package to really address if it came to a default situation or increasing concerns about the stability and viability of the levels of debt in those markets. The Italian bond market, for heaven's sake, is the third largest bond market in the world still, and there is just not enough money available given all the challenges that are going on. We have just about enough money to keep Ireland, Portugal, Greece, the smaller economies afloat. If there is a problem, if there is a buyer strike and a restructuring required. But if we get to a very severe economic situation in Italy or Spain, there is just not enough money there available to keep these economies supported. So that's a pretty bleak turn of events for some of these economies. And actually, the news in my opinion, gets worse when we look at some of the long-term trends for the likes of these smaller economies. And even some of the larger ones, talking about Italy. Italy is still one of the more significant economies in the world. When we look at the long-term trend rates of growth here, it's a pretty alarming situation. The potential rate of growth. So the top part of this chart looks at the actual GDP results from Italy over the last little while. So back in recession, essentially, for Italy. When we look at, on the lower chart, the potential rates of growth, so where the economy could be growing, and the actual average rate of growth over the last, on a rolling 5-year basis, we can see that the trend rate of growth is declining quite significantly, and the potential rate of growth for Italy is virtually zero. So that's a bit of a challenge for an economy that is paying away 6% per year for its long-term government debt. We haven't, as I keep saying, repealed the law of mathematics, as far as I'm aware. If you are not growing your economy, if your rate of growth is zero and you're paying 6% for your long-term debt, the simple law of mathematics suggests that it's going to be very, very difficult for you to get ahead of that fiscal curve. You're not going to be able to reduce your government imbalance and get to a primary surplus situation without some very, very significant cuts in government spending. So the trend rates of growth are declining. Debt levels are very significant. Unemployment rates in many of these economies is very, very high. And recession is back on the radar. We've had a couple of quarters now of negative growth in many of these economies that we're talking about. Portugal, Italy, as I said, back in recession. Ireland as well. The Greeks are starting to cheat a little bit, and they're not releasing their quarterly numbers anymore. But we kind of know where that economy is. It's not growing at all at the moment. So we're lacking a little bit of data here. But as I say, they're starting to cheat with some of the numbers. So growth is a problem, unemployment is a problem, debt levels are a problem, the rates of interest that these governments are having to pay to float their debt is a problem. There's a whole bunch of challenges here for these economies to get their heads around, and we're not entirely confident. I'm not entirely confident that they can do that in a timely fashion. The nub of the issue, though, is really the getting back to that competitive problem that I talked about early on with the balance of payments problem. This is a chart I've used a lot in presentations I've done about the Eurozone, and I've been quite, not to blow my own trumpet, but I've been quite negative on the outlook for the Euro for quite some time, just because the economics of it don't make sense. And that's one thing we have to remember about the Eurozone. It is an economic construct, really, but it's driven by politics. If the economic rules were applied to the Eurozone very strictly, we would have started off with a group of countries in the Eurozone of maybe no more than 5, probably closer to 4. And there have been constant abusers of the rules that govern the formation and running of the Eurozone for quite some time. But they've gotten away with it because there was a political desire within Europe, 60 years worth of political investment post-World War II to get this thing going. So they've been tolerant of abuses. But lo and behold, now we're starting to realise that the whole thing is a little bit half-baked, as I think Margaret Thatcher said a number of years ago. Anyway, I'm getting a little bit off base here. This is another the issue for me in terms of Europe, the Eurozone, and why the Euro doesn't work and probably won't work moving forward. So they all use the Euro in nominal terms. If anyone's travelled to Europe, you know you can spend €1 in Greece and spend €1 in Germany, and it's the same €1. But you probably do notice quite a bit of a difference in how far that euro goes in Greece or Germany. Now, in North America, in Canada and the US, we have a kind of uniform rate of inflation across the countries. We're large, diverse economies in both cases, but we're administered by the federal government, the Federal Reserve, and the rates of inflation do not vary that significantly from Florida to California. The rate of inflation is more or less uniform across across the states. And there will be some minor regional variances in terms of perhaps gas prices and that kind of thing. But generally speaking, the rate of inflation that you see on the West Coast is pretty much what we see on the East Coast. In Europe, it's a little bit different. They've all been running essentially their own rates of inflation. And what that means is that although in nominal terms, as I said, the €1 that you spend in Greece is the same €1 that you spend in Germany, in real effective terms on the ground, the euro that Greece uses has become mightily expensive because there are rates of inflation and rates of compensation, and Ireland as well. But the rates of compensation in these smaller peripheral economies within the Eurozone has been significantly higher than Germany. Germany's done a great job of keeping control of wages and prices. And in real effective terms, the euro that Germany uses now feels about 10% cheaper than it did when the euro was introduced in Germany almost 12 years ago. Even though the nominal exchange rate, so where the euro-dollar exchange rate is right now, is about 10 points higher. We started off around 115 and we're trading around 126 this morning. So Germany's done a great job of keeping control of wages and prices. It's very competitive. The other countries in the Eurozone, particularly these smaller peripheral economies that we're talking about here, the islands, Italy, Greece and Spain, as you can see, the real effective exchange rate on the ground has been vastly, vastly different. So what the euro that Greece uses effectively feels like is much, much more expensive than what Germany uses. And that kind of makes sense. If you had a competitor in your business just down the road from you, that was paying its workers and its input costs at a 20% higher rate than you were, it'd be unlikely that that business would stay in business for any significant length of time. They're paying over and above the odds for compensation and for their inputs. So rates of compensation and inflation have been significantly higher in many of these jurisdictions that we're talking about. The average is probably similar to or a little bit closer to the German experience. So on average, Europe has done a pretty good job of keeping control of wages and prices because they have an inflation targeting central bank. But when we look at the countries in isolation, rates of inflation in these countries have been very, very significantly different from the European experience in aggregate. So it's a rather complex way, and I hope I'm clear here in what I'm trying to explain to you, of illustrating the fact that in a single currency area where competition really shouldn't be an issue, because these countries have allowed rates of inflation and compensation to run well ahead of the average of their competitors within the Eurozone, they're essentially pricing themselves out of their own markets. Greece used to be one of the cheapest places to go in Europe for a vacation. It's about the only thing that Greece actually produces in terms of a foreign exchange revenue generator. It doesn't export very much, but it used to be a very nice, very cheap and very pleasant vacation destination. But it's extremely expensive now for anyone to go to Greece. Anyone that's gone to Greece recently will testify. So what's the normal response for a country that's not competitive? It's to devalue their currency, slash interest rates, start all over again. Can't do that. They've given up sovereignty over the exchange rate. They've given up sovereignty over monetary policy. So the only alternative for these countries is to undergo what we will term an internal devaluation. They have to get wages and prices down to a point that brings them back in line with Germany and at least the average experience of the the Eurozone in aggregate to become competitive again. How do they do that? Well, it's back to austerity and outright depression levels of activity. It's putting outright real downward pressure on wages and prices. Businesses in these countries are having to go to their workers and say, wage compensation is going to fall by 10% this year, 10% next year, and probably further moving forward. They're reducing benefits and payments significantly to try and get the deficits under control and become competitive again. So this is a very significant challenge, and it does imply that this very austere, very slow growth environment that Europe has been used to is going to keep on for quite some time. This is something that the economist, I'm not an economist, but this is something that the economist would refer to as a Phillips curve. And it illustrates something that we would probably intuitively appreciate in terms of high unemployment. When economic activity is rather slow, we tend to see very low inflation or even outright negative inflation. When unemployment is low, when the economies are moving quite nicely and there's more money sloshing around the system chasing fewer goods and services, the inflation rate tends to be high. And this is the Irish situation here, up to 2012, and including estimates for the CPI rate and so the inflation rate and unemployment rate into 2015. And what the estimates suggest is that the normal response, actually, I should say, so far has been pretty much as we would have expected. As the unemployment rate has crept up in Ireland, inflation rates have moved down. That's good. That's what Ireland wants to achieve. They want lower inflation, negative inflation, deflation, in fact, to get competitive again. But as we move forward, we can see that in terms of the expected projections, the estimates here, inflation is expected to creep up again this year and next year, and the unemployment rate is actually expected to stay quite high. What we need to see is even higher inflation if Ireland is to get ahead of the curve here, and in terms of pushing wages and prices down. So the news is really quite poor for the outlook here for these economies. They need higher unemployment than they already have. We're already talking about double-digit unemployment for many of these economies. They need even higher unemployment to get wages and prices down to levels that leave them more competitive. So what's happening on the ground? You've probably seen this week reports that investors in Spain, this morning there was a story, one of the bank I saw this morning just as I was coming in the room here, Bankia, which is one of the newly created banks in Spain, their share price is down 20% this morning because there's been a bit of a run on the bank. Investors are withdrawing deposits from that institution because they're not too sure about its outlook. And there was a story earlier in the week that Greek investors have started to withdraw significant amounts of deposits from the banking system there. They lost about $1 billion worth of, close to $1 billion worth of bank deposits just on Monday alone. So that's pretty significant. Investors are starting to vote with their feet. Banks in Greece have been hemorrhaging deposits for quite some time, and for any bankers in the room, we know that's not a good thing. If investors are pulling deposits out, there is a risk of a run on the banking system. That's essentially what we're starting to see now in some of these smaller economies, which is going to complicate the outlook and the resolution for these problems. Losing $1 billion in a day is actually very significant. Greece lost about $35 billion overall in bank deposits for the entirety of last year. So losing $1 billion in a day does suggest that the situation on the ground is becoming increasingly tense. And it's not just on the deposit level that we see this. We see foreign investors starting to shy away from the debt markets of these economies. So when we look at the Italian bond market, we can see that resident and non-resident participation in the markets has actually changed quite significantly over the course of the last year or so. There was a fairly steady increase in non-resident participation in the Italian bond, the third largest bond market in the world, as I said. There's a very steady increase in non-resident participation in the Italian bond market throughout the entirety of the euro's lifetime prior to the past year. In the past year, we have seen a very significant shift away from investments by foreign investors in Italian government debt. They don't like the outlook. They don't trust what's ahead. So bringing all these things back to, or trying to bring all these things back together to the exchange rate is pretty easy. I think the euro should be quite a bit lower than it is right now. Many of the indicators that we use on a regular basis to try and assess where currencies should be trading suggest that the euro should be lower. So we're here looking at the light green line is the ratio of the stock index performance of the European banks relative to the US banking stock index, the KBW index. And we can see that that's been a pretty good proxy for how the euro exchange rate has performed over the last few years. When European financials are outperforming, the euro tends to do better. When US financials are outperforming, the euro tends to do a little worse. And where we are right now, with that quite significant underperformance, the worst performance we've had, in fact, relatively speaking, for European financials relative to the US in the past 4 or 5 years, that suggests to me that the euro should be quite a bit lower. We're getting close to, I think, where we should be with the exchange rate moves we've had recently. The US dollar index is up for 14 straight days now. We haven't had a run like that in the US dollar index since the 1980s. The dollar is on quite a roll. 14 days doesn't sound like much, but markets tend to fluctuate quite rapidly. So 14 straight days of appreciation in one currency is very, very unusual. I've been doing this for a long, long time. And 14 days straight of appreciation is quite an unusual turn of events. When we look at the size of the balance sheet of the Federal Reserve relative to the European Central Bank, again, when the Federal Reserve was expanding its balance sheet more aggressively than the European Central Bank, the dollar was under pressure and the euro tended to appreciate. In 2011, the boot was on the other foot. The euro started to depreciate as the European Central Bank became more aggressive with its balance sheet. And again, where we are right now, the light green line, the nominal balance sheet ratio between the Federal Reserve and the European Central Bank suggests that the euro should be at least in the 120s and probably even a little bit lower. And the same goes for nominal yield spreads. For the first time in a long, long time, short-term yields in the US are yielding a premium to Eurozone short-term interest rates. And interest rate differentials are typically a fairly strong driver of short-term performance for currencies. Investors like to buy the high-yielding currencies and sell the low-yielding currencies. So what we've seen recently, where the interest rate differential, the dark green line there, has moved in the dollar's favor, has actually not been reflected in the way the currency has performed. The euro has actually appreciated since the start of the year, despite that that yield discount to the US. So that, again, is a little unusual. Since I put these charts together, we have had quite a significant move in the exchange rate. So when I put these charts together, the euro dollar was still trading above 130. And as I said this morning, we're trading around 126. So we've had a 5-cent move in a very short space of time. So we are starting to catch up with some of these signals. I think one of the reasons why the euro has probably not moved as much as many people would have expected it to in the current environment is because there is a kind of vested interest for some of the larger parties, if you like, involved in the global economy these days. We often talk about the Chinese-US trade relationship as being an important development for the markets, and we focus on the dollar-yuan exchange rate quite a bit. But in reality, Europe is a larger trading market for China. They export much more in terms of goods to Europe than they do to the US. And as you can see, Chinese exports to Europe have actually been very, very weak recently. And I think it's perhaps a little bit of hidden hand participation by the Chinese authorities in the markets at the moment, trying to dampen volatility in the euro exchange rate. There is a little bit of perhaps manipulation going on in the markets at the moment. China is a very active participant in the foreign exchange markets, and they tend to try and guide exchange rates at times in the way that they see fit for their own interest. And I think there is perhaps a little bit of not direct intervention, but certainly dampening activity. China is essentially buying euros and trying to dampen volatility in the euro-dollar exchange rate because they are concerned, I believe, that a deterioration in the situation in Europe would be very, very detrimental to their export outlook. I'm going to run on now to just a kind of broad characterization of how markets move, my way of kind of looking at the markets, and my longer-term views on the dollar. I've been a long-term dollar bear, and I'm actually becoming increasingly bullish on the longer-term outlook for the US dollar. One of the reasons for that, one of the principal reasons for that, is that as a market and as investors participate in the market, we tend to behave in the same way to similar sets of circumstances. So here we have a kind of stylized economic and investment cycle, and that kind of characterizes the type of investments that people get involved in the early stages of expansion, into the late expansion, and then the early contraction phase, the kind of investments that investors typically get involved with. And that's reflected also in this kind of stylized market cycle as well, where in the early stages of a bull market, we have the early movers who get the kind of early advantage that's marked by or followed by the markup stage, rather, where we get increasingly rapid gains. We start to see more interest from the media in some of the market moves. We get latecomers coming to the market that kind of coincides with the distribution phase. So the guys that were in early are starting to sell, profit taking. The latecomers get stopped out as the market starts to roll over. And we kind of move through the downward cycle and onto the next cycle for whatever market we're typically looking at here. So we're looking at accumulation, markup, distribution, decline, followed by accumulation again. And I think that's appropriate because, to my mind, that's kind of what we're seeing in the US dollar at the moment. The US dollar is a very cyclical currency from a long-term point of view. Since the advent of floating exchange rates in the modern era, in the 1970s, the dollar actually has been a very cyclical currency. It tends to do very well when it has a growth advantage or a yield advantage relative to its larger trading partners. Here we're mainly talking about Europe. or it tends to do well when the rest of the world is not doing very well at all. So there's a refuge value, a safe haven value associated with the dollar. But you can see those alternating swings of strength and weakness are quite well defined, quite regular. They average out to about 8 years. We don't have a lot of history here to look at, admittedly, but this is a fairly long period of time for the foreign exchange markets. Foreign exchange markets are still a relatively new phenomenon for us, only 40 years worth or so of experience. The most recent decline, the secular bear trend we've had in the dollar since 2001, 2002, in this respect is looking very long in the tooth. We're about 10 years into it right now. The dollar is looking very, very cheap against a range of currencies. I have the pleasure of talking to you here this morning, but we market to central banks and sovereign wealth funds around the world, and one of the messages that I've been telling these people constantly, as we've heard a lot about diversification away from the US dollar, is that they're doing exactly the wrong thing at exactly the wrong time. They shouldn't be selling dollars right now. They should be buying dollars. You shouldn't be buying Australian dollars at 108 US cents, the highest we've seen in the Australian dollar pretty much in its lifetime. It's a market. We buy low and we sell high. We should be buying cheap things and selling expensive things. And the dollar, to my mind, looks extremely cheap at the moment. And perhaps they're starting to listen because over the past couple of quarters, central banks have actually started to increase a little bit their holdings of central bank reserves. And this is myth number 2 that I want to try and dispel this morning. This notion that because of what's been going on in the US economy, because of what's been going on with the Federal Reserve, and perhaps because of fiscal policy issues in the US, central banks and investors, generally speaking, have been dumping the US dollar. That's just not the case. From a long-term point of view, so here we're looking at the International Monetary Fund's composition of foreign exchange data, the COFA data. So every quarter the IMF goes out and surveys central banks around the world, and they say, what do you have in your portfolios? What are you investing in terms of currencies? And lo and behold, we have seen a bit of a move away from the US dollar. So we only have about 10 years worth of data here. But if I had a bit more data, that would be well within keeping of the typical fluctuations that we see in foreign exchange holdings. The dollar proportion of foreign exchange reserves has been as high as 80% and as low as 50% over the last 40 odd years, I believe. And where we are right now is not too disturbing from my point of view. As I said, the last couple of quarters we have seen a bit of an increase in dollar holdings in central bank reserves, around 62%. So we're just under 2/3 in terms of US dollars held in foreign exchange reserves by global central banks. That's a pretty good proportion. That doesn't suggest any sort of panic to me that investors, generally speaking, are worried about the outlook for the dollar. They should be buying dollars right now. The dollar is extremely cheap. Where we have seen a bit of a shift is in the euro, actually, interestingly enough. The euro's proportion of global reserves has declined by just under 2 percentage odd points over the last 18 months to 2 years. The darker green line there at the bottom is where the rubber hits the road for us. We have seen a lot more interest in Canadian dollars, Australian dollars, the other category. These are typically underused, under-owned, if you like, by global central banks, and we have seen significant interest in some of these smaller but still relatively strong economies. But the message here really is that the dollar is not going away as the global medium of transaction, as the global store of value for central banks, with central bank reserves still holding around 60% of their reserves in US dollars. That's a pretty good sign, I think, of confidence in the dollar's longer-term outlook. And as I said, the dollar does look quite cheap, in my opinion. So we're almost done here, don't worry. Last chart looks at really the growth situation between the US and Europe, and illustrates the point I was making with that chart on the dollar's performance over the last 40 odd years. So our forecast calls for about 2.5% growth in the US for this year, about negative 0.5 in the Eurozone. That's going to give a growth differential of around 3 percentage points, which is the dark green line on the chart there. And that takes us back to probably the best performance, relative performance of the US economy. Not great growth levels here, certainly by recent standards, but enough of a growth advantage for the US economy relative to Europe to take us back to the kind of heyday of the dollar, the early 1990s, when the dollar was last on a roll. And that's actually going to stand the dollar, I think, in pretty good stead over the course of the next 12 to 18 months at least. It does suggest to me that the dollar can do really quite well. And I'm a big student of, as I said, market cycles and technicals and investor behavior. And when I put that chart together, so the dotted blue line there is euro dollar, Now, obviously, it's the antecedents of the euro prior to 1999, but that's essentially the euro-dollar exchange rate, as we've seen through the course of the last 20-odd years. And it struck me that what we're seeing over the last two cycles in the US dollar, so the appreciation of the euro in 2000, the peak in 2001, 2002, looks very much like the decline that we had in the early 1980s in the euro, the appreciation in the euro that we had in the early 1990s, prior to that big leg down in the euro-dollar exchange rate that we had from the early to mid-1990s onwards, which was, as I said, the heyday for the US dollar. So from a market cycle point of view, things seem to fit here that point to the potential for quite a significant dollar rally moving forward. The way investors behave, the dollar is cheap at the moment, but people should be buying the dollar, I believe, suggests that the dollar can do a little bit better. Now, we're not actually forecasting a significant rally in the dollar. We are forecasting over the next couple of quarters a bit more appreciation in the US dollar, depreciation in the euro. I would be there are almost as many people involved in our forecast process as we have in the room here this morning. So inevitably, there's a bit of a compromise involved whenever we get these forecasts together. We have to come to sort of a holistically realistic view between our interest rate colleagues, my macroeconomic colleagues, the economists and the commodity guys. And one of the issues that we do have a little bit of a concern about is the so-called fiscal cliff, the potential for tax rates to rise quite significantly in the US in the early part of next year if there's no resolution to the current issue of what's going to happen with the expiring tax cuts. So there is a bit of a bump in the road potentially for the US economy. Dollar has a significant yield advantage at the moment. It has a pretty significant growth advantage. It is extremely cheap against a range of currencies. I think the dollar can do quite a bit better here. So that's good news for all the importers in the room. It should mean that your ability to buy goods abroad, your purchasing power, if you like, is going to increase. If you're an exporter, probably not such good news. But the dollar has been quite cheap for quite some time, and I think we're due a bit of a correction. So that's it, I think, in terms of my little spiel. We do have perhaps some time for Q&A before we move to the panel, I think, if anyone has any questions. Yes, sir. Start with you.
As you alluded to the fact that the U.S. Federal Reserve did a good job with monetary policy, could you please share your thoughts on fiscal policy and the combination of fiscal policy and monetary policy on our current account and the future of the dollar?
Well, I think that is going to be a challenge. I'm not an economist, as I said, so I don't. We're still trying to debate exactly what the outcome of the fiscal deliberations are in Washington. Generally speaking, though, I would say that in many jurisdictions around the world, we have gotten to a point where debt levels have risen to very significant levels, and we do seem to, historically, if you go back, you look, you can see many occasions in the past where governments have got themselves in very similar situations. And again, I get back to the point that we haven't repealed the law of mathematics, as far as I'm aware. We do have to address spending and revenue issues in not just the US, but in many places around the world, I think, to address some of these issues. I think the bottom line for the global economy as we try and address some of these fiscal imbalances moving forward is that growth is going to be slower than we're used to seeing as we try and tackle some of these problems, and probably for quite an extended period. But I think when we look at the capacity to generate revenues and to address some of these issues, I'm much more confident in the US's ability to do the right thing, maybe eventually, I think, as Winston Churchill said. To do the right thing eventually, because there's a greater capacity here to maybe make some pretty obviously very hard political decisions, but some relatively easy revenue generating decisions that will, I think, potentially address the issues quite readily. In Europe, I don't have that confidence. When you're talking about relatively high levels of taxation already, VAT rates so value-add sales tax in excess of 20%, 25% for Ireland, gasoline taxes that are already through the roof. Norway pays $9 a gallon for its $9 a gallon for its gas, and that's partly because of the exchange rate. But taxation levels for gasoline, for example, are significantly higher in Europe than they are in North America typically. So there is a way out here. I think we have to be confident in as I say, eventually people doing the right thing, but it is going to be, it's not going to be an easy task, and it is going to mean that probably growth is quite a bit slower than we're used to seeing, unfortunately. There was a question at the back there.
My company is an exporter of industrial products, and increasingly our business is in countries like China and Brazil, Poland, Mexico, those kinds of places. Do you have any comments on where you see the U.S. dollar trading against some of those kind of BRIC-type economies?
Yeah, so I'm not a brick specialist, but I can tell you, generally speaking, these economies are coming on stream quite quickly. They are very sensitive to the levels of appreciation in their own currencies. We know that China's essentially managing the rate of appreciation in the yuan. We're looking for a little bit more appreciation in the yuan exchange rate over the course of the next 12 to 18 months. It's probably not going to move as quickly as we thought, and we had a very conservative forecast for the yuan actually over the first half of this year. We essentially thought it would stabilize around 630. Although my crystal ball has been pretty murky over the past year, that is has been one of our better forecasts. Ironically, forecasting no movement actually turned out to be the right thing. It's probably going to hold around there, I think, at the moment. I think the Chinese are essentially doing what they did in 2008 when they held the yuan exchange rate around, I think it was 685 at the time, because of the financial crisis, and they wanted to try and provide some protection, some cover for their own economies. They stopped the yuan from appreciating and held it in a very narrow trading band as the global economy went through the financial crisis. And I think we're seeing something similar right now. They're just holding the yuan around that 630 point. Most people assume that the yuan will continue to appreciate. I think we're getting to a point now where the yuan is potentially getting closer to fairer value. It probably can appreciate a little bit more, but as we get to the 575, 6 yuan area, which we think is reachable over the course of the next little while, that may be about as much as we can expect from a long-term point of view. I don't say I'm not a yuan expert, but my sense is that we probably will not see much more appreciation beyond that. In terms of the other economies, Brazil has been trying to talk down the real recently, and they've been pretty successful at that. The dollar real exchange rate has been over the last little while anywhere between 160 and 2. We're up closer to the top end of that range at the moment, so the dollar is appreciating against the real. I think in a low yield environment, a relatively high yielding currency like the real with relatively strong economic fundamentals is going to be attractive to investors. What we're seeing at the moment, though, is that generally speaking, because of the uncertainties in the world, investors are either selling winners to pay off losers. They get margin calls on all sorts of things. So all the winners that investors and hedge funds have had recently are starting to. So gold prices, for example, have been falling quite dramatically. Some of the equity markets obviously have been under quite a bit of pressure, so we're getting margin calls on many of the winners that hedge funds have had. So I think that's one of the reasons why the real has been under pressure. The government has also been quite verbal in trying to talk currency down. I wouldn't expect it to depreciate much more than current levels. I think the range that we're forecasting is essentially around 180, 185 over the course of the next so through the end of 2013 is the kind of forecast horizon that we're talking about. So we would expect a little bit of appreciation from here. It probably has overshot to some degree, but the government has been trying to talk the currency down, and they are concerned, I think, that recently appreciation has been a bit too rapid. Yes, sir.
I have just a measurement question. When imports and exports and balance of trade are calculated, does it include only hard goods, or does it also include soft goods such as education, consulting, and exchanges of expertise?
It depends on the measure. Most of the balance of payments numbers that I've been throwing up there would include goods and services. You can include so-called visible trade in the balance of payments numbers.
So would it include a lot of, for example, students coming to the United States for education from overseas?
The goods and services in balance, yeah. I'm not quite sure honestly how that's included in that, but typically speaking, that would be figured into the numbers in some way, shape, or form.
All the scenarios that you're presenting tells me that our equity market is pretty cheap, but why is it not reflected in the actual pricing?
Okay, I'm not an equity guy. I think one of the issues at the moment is there is a risk aversion. We're in a very kind of black and white market right now, and it's we can turn on the screens in the morning when we're getting to work, and the first thing we look at is what the overseas equity markets have done, and it's a kind of circular thing. Obviously, markets trade 24 hours over 24 hours, but we're entirely dependent on the news flow at the moment. If investors are encouraged by what's going on around the world, equity markets are up. And that follows on into our session in North America. When we see negative headlines about political developments in Europe, for example, equity markets tend to move back. There is a lot of fear in the markets. The two overriding drivers of any market, fear and greed, and there's a lot of fear in the markets at the moment. So there's a very binary sort of, and markets are very highly correlated as well, very unusually. In my experience, we see equity markets, commodity markets, bond markets, currency markets, all very highly correlated at the moment. So when equity markets go up, the dollar tends to go down. When equity markets go down, the dollar tends to go up. And we see that reflected in many other asset classes, that high level of correlation. I don't honestly have a strong view about the richness or cheapness of the equity markets here. I think that from a shorter term point of view, I grew up in the markets in London, and the old timers there used to say two things constantly: never buy a currency that ends in a vowel. That's been a pretty good lesson. So pesos, pesetas, drachmas, and sell in May and go away, and that's the other old stock market adage. And there is a seasonal influence on our markets for whatever reason. It's well documented in the literature. It's been there forever. The period between June and October, typically in most global equity markets, is just not good. Not always negative, but it's just not good relative to the rest of the year. Some people call it the Halloween effect. Markets tend to pick up again a little bit in the latter part of the year after November. But it's well documented in the literature. We've done some work on it ourselves over the last 20 years. When you look at the S&P 500, the period of returns from June through October are definitely worse than the rest of the year. Actually, over the last couple of years, I've been coming to New England at about the same time I do the T-Main conference in Boston. And the last 2 years, every time I've gotten off the plane when I go home, one I think 2010 was the flash crash. And in May last year, there was another big down day when I was going home. So May tends to be a bit volatile. But selling May and go away, I think, from a short-term point of view, is quite appropriate. There is a lot of concern in the markets, a lot of fear, and it probably does mean that over the next little while, equity markets, risk markets generally, are going to have a bit of a bumpy ride. Doesn't necessarily mean to say they're going to go down. But it probably means that returns month by month over the next couple of months are going to be quite a bit worse relative to what we've had previously. So I think that I don't honestly have a good answer for you. I'm not an equity person, and I'd probably be overstepping my pay grade if I did actually make any sort of specific comments about stocks. So I'll keep it to something very generic and say that I'm not confident about the short-term outlook for risk assets just because of the level of uncertainty that we have around the world at the moment. I'll leave it at that.
Okay, why don't we're going to actually have a panel discussion, and then we're going to have a bunch of Q&A sort of embedded in that. So why don't we sort of get to that second speak, if that's okay?
Perfect.
Shaun, thank you for a terrific keynote talk. I'm going to, just a couple, Shaun's going to join the panel. Just a couple of quick observations. One, it sounds like the next couple of years is a good time for planning that European vacation. And number two, Shaun's going to be joined in our panel here by a couple of companies who do significant exporting. So it should be an interesting conversation. I would like to bring up the editor of the Worcester Business Journal, Rick Saia, to introduce our other two panelists and get going on this part of the discussion. And like I said, this will be a very interactive kind of Q&A session, so I'm sure we'll get to some of the other questions that were coming from this side of the room. Thank you. Rick, come on up. And thank you again, Shaun.
Good morning, everybody. Very pleased that Shaun is sticking around to join the panel. We like to have a panel of three. We tried our best to line up a third panelist from the manufacturing industry. So we called up one, and he says, well, I'll be in China. Another one said, I'm going to be in Brazil. And another one said, oh, sorry, I'll be in Germany. So there's evidence that there's a lot of activity going on in the global economy. You already know Shaun. The other two panelists are John Stowe of Litco Inc. in Worcester and Wayne Canty of Heat Trace Products based in Leominster. About John, he began his career working for Worcester's Lundquist Tool in 1965, and upon taking over the reins as president and CEO of the company's name was changed to Lutco Inc. Lutco includes Lutco Bearings and Lutco International, as well as other affiliated companies. Lutco is a global supplier of quality semi-precision bearings, metal stampings, and housed bearing assemblies with leading positions within its markets. Their customer base is in major industrial markets that include farm machinery, consumer durables, material handling, trucking, industrial equipment, and recreational vehicles. John is active in several community organizations, including the American Antiquarian Society, Higgins Armory, UMass Medical School, and Associated Industries of Massachusetts, as well as the Massachusetts Manufacturing Extension Partnership. So please welcome John Stowe. Wayne Canty is president and CEO of Heat Trace Products, a company he acquired in 2004 from the Marmon Group, which is a Berkshire Hathaway company, and the company was established in Clinton. In 2005, the factory was relocated to its present site in Leominster, a move that required an investment of over $1 million in upgrades and new equipment. Wayne is a veteran of 44 years in manufacturing, specifically the wire and cable industry. He travels extensively throughout the world promoting his company, where at least 60% of current business revenues are generated from global exports across 30 countries. Prior to the acquisition of Heat Trace, Wayne served as vice president and general manager of Rockbestos Surprenant, I got it right, now a Berkshire Hathaway company, which leads me to ask you, are you trying to avoid Warren Buffett? Among its honors, Heat Trace Products has been recognized as Massachusetts Exporter of the Year in 2006 from the U.S. Small Business Administration. The company won a global trade award for international business in 2010 from AIM, the Associated Industries of Massachusetts. And this year, it was one of only 12 U.S. companies to be recognized as a DHL Think Global Exporter of the Year. Wayne has been a member of AIM's board of directors, the board of directors for AIM's International Business Council since 2011. And also last year, he was appointed by Governor Patrick as a member of Massachusetts Marketing Partnerships Board of Directors. So please welcome Wayne Canty. Well, gentlemen, first it would help if each of you can spend a few minutes sharing with the audience how your company does business abroad. Where do you do business, how you do business, and what the benefits and challenges are for your company in the countries where you do business. Wayne, how about if we start with you?
Well, as you mentioned, we do business in 30 different countries around the world. Our largest market is the CIS countries, former Soviet Union, and the Asia. Well, China would be number two. After listening to Shaun, I think we may be bailing on our global business endeavors, but I'm sorry, the second part of your question, Rick?
How you do business and what the benefits and challenges are for your company. And
well, being a small company, we don't have we have not had the resources to do what's the larger. I remember being with the larger company, and if someone said, okay, we're going to do business in Brazil, I would simply say to a staff member, go do business in Brazil, and within a few months we were doing business in Brazil. So it was relatively easy. Nowadays, with our small staff, we have to do everything ourselves, and it's not quite as easy. Each country is very different in how we conduct business. I have Deborah DiOrio here with me today, Vice President of Sales and Marketing, so I have to be careful about taking credit for things that I don't do and she does. Normally I don't see her at these events, so I can lie and take full credit.
Yeah, which is being recorded.
I remember going, just recently going with the governor on the trade mission to Brazil, and even though I was already doing business with Petrobras, the national Brazil oil company, I felt very cavalier that, well, it's very, it's relatively, it will be relatively easy to expand our presence in Brazil. After all, we're doing business now in countries like Kazakhstan, the country of Borat. So how difficult can it be in Brazil? Well, in fact, it's probably one of the most difficult countries to do business in, or to establish yourself in, with all of the regulations, the taxes, the consumer protection laws. However, they're extremely receptive to importing manufactured goods, technology, etc. So once one gets beyond those hurdles and establishes themselves in the country, there is a lot of support in Brazil. As far as getting established, I have to point out the resources that are available. More often than not, I'm talking at on these panels to small and medium-sized companies that are interested in getting into exports. The resources that are available in Massachusetts are overwhelming, and there are some here today. I see Julia Dvorko is here from the Mass Export Center. They have done, they've been a wonderful supporter of ours. Julia recently had an intern do a marketing report for us or marketing study and report for us in China, which we still have to discuss further. There's the U.S. Commercial Services, which I don't believe there's a rep here. Oh, here we go. Their Gold Key service is probably one of the most, that's really the crown jewel of a relatively cheap marketing study to be done in any given country, and working with the U.S. Commercial Service officers in these from these countries. They do a wonderful, wonderful job. And if you're a business in Massachusetts and you are not a member of AIM, Associated Industries of Massachusetts, and I see Kristen Rupert here, the Executive Director of the International Business Council. Just wave your hand, Kristen, so people can see. You're doing yourself a real disservice if you are not taking advantage of an AIM membership in Massachusetts. I don't want to, I get on these roles and just, spew, so let me stop there for a minute and take a breath, and Rick, you can continue.
Thanks, Wayne. John, how about you and Lutco? Where in what countries do you do business? How you do business, and the benefits and challenges that Lutco faces?
We're a little unique as far as our approach to the market. I came here hoping to learn a lot from Wayne because I know he's been well recognized in penetrating international markets. We're a relatively small company too, and unique in the fact that most of our products are customized to the customer's requirements. The reason that's unique is that if we had a commodity and we could issue a catalog and sell that way, it would be a lot less labor intensive as far as penetrating markets. But because it's really almost a one-on-one expansion into any market, we've taken an interesting approach, and that is that I started selling overseas more because we were seeing some of our good domestic customers with their plants overseas taking our products and exporting them. We do a lot in the agricultural industry, which has maintained a great deal of strength worldwide, obviously, Brazil being one of the major markets expanding. And so I found that if I went overseas and met with those particular divisions, I could expand the market. I also got a little more confident at selling overseas. I found that in Europe everybody speaks English increasingly, so it was a relatively easy area to sell into. We sell into about 10 countries internationally, and we started penetrating really using the main players that we could identify in foreign countries that did the same thing that our customers did. When you do a lot with John Deere, for instance, domestically, and you find that they're also shipping your products into Saarbrücken, Germany, or Arc-le-Gray in France, it's much easier to go into a market and begin to talk about what you're doing for those customers, and that gives you credibility. So where I could talk directly with the engineers in companies other than the Deeres and the C&Hs, which is an offshoot of International Harvester, owned by Fiat actually, and AGCO, which is the old Alice Chalmers. I could penetrate into many other agricultural markets. I would find them by going to the farm shows. Obviously, every industry has its own set of shows, so I found that if I wanted to sell into the trucking industry, we're very dominant in a couple of areas in the United States. We have 100% of the U.S. market in a particular kind of bearing used in trucks. We have about 60% of the world market. I'd go to the truck show in Hanover, Germany, and go around to the booths, and I found that salespeople are very easy to talk to. I could find out who to talk to in these various companies, and we ended up selling companies in places like South Africa by just picking up the phone and calling and talking to the people that I had the name of, telling them who I did business with in the United States. That gave me instant credibility. And we sell quite a bit into Germany. The fluctuations in the currency have not helped us of late because there is competition in Europe for selling the kind of products that we have. But where I focused on the particular kind of products that we sell in the United States successfully and have made a real niche market there, I found that I can expand into other countries the same way. The difficulties I've run into in Europe have been representation. We're not big enough dollar-wise to establish a footprint on the ground, and many of the kinds of companies we do business with in Europe want just-in-time delivery. They'd like to have product on the ground. I'd like to be able to call up and in 2 weeks have the product on their shipping dock. And if you've tried to do business in Europe, you know that if you hire somebody, you own them. It's very difficult to get rid of them. And if you hire a manufacturer's rep, which is mainly how we do business in the outlying areas in the United States and Canada, you also own them. There are commercial codes that prevent you from firing a particular agency without it costing you a fair amount of money. And that's a difficulty because small rep agencies have a lifespan like a company, but a much shorter duration. Usually the young, aggressive salesman goes out and beats the bushes and gets you good penetration, and then as he begins to make a good commission, he takes more vacations, and sometimes he brings in his kids who can't get a job somewhere else, and then you have to make changes accordingly. So that can happen in a relatively short period of time. And we see that in the United States, quite honestly. And we find we obviously can roll over staff, but training somebody to sell a very unique, customized product takes a while and takes a lot of effort that way. So quite honestly, I've ended up having to do most of the peddling in Europe and elsewhere myself. You can hit a lot of places in Europe. You can call in Germany. You can go to Italy. You can be in Poland, all within a matter of a week. I go over on a Sunday night and come back on a Friday, and have hit many accounts, consecutively, and come right back. So that's the way we've penetrated the market. In Brazil, local content is a difficulty. I have contemplated whether I should get into a joint venture there in order to get a toehold. Language is much more of a problem there, as is security. I haven't had any difficulties security-wise, but I've been warned many times that São Paulo and Rio are not cities you wander around in without some kind of either protection or whatever. I've tended to travel further south and west, and those areas, the rural areas where the companies that I call on are a little easier to work with. But still, Portuguese is a very dominant language, and there are very few people who speak English. So those are some of the difficulties we've run into, and some of the advantages to penetrating the roughly 10 companies. It's about 10% of our total volume, and we're a small company, so we've had to do it really by ourselves.
Thanks, John. Pretty good global view. Last year, as Peter mentioned, we focused our attention on China, no doubt the 8,000-pound gorilla when it comes to the global economy. But I think in the past year, it has gone on a bit of a diet, or at least it's getting less media attention than it did. We've heard of the BRIC countries, BRIC, which stand for Brazil, Russia, India, and China. And as was alluded to earlier, Governor Patrick went to Brazil on a trade mission to try and drum up some business for the companies in the state. Of course, Shaun mentioned the situation in Europe with countries, beset by debt and the political changes that have marked a reaction to that. You have high inflation in Argentina, rapid growth in Brazil, and growth throughout Latin America. So just to paint a small picture of what's going on in different parts of the world. So what I'd like to do is I'd like to pose some questions to the panelists, and I'd like to start with either Wayne or John. Of the foreign markets that you're in, which has proven to be the easiest to enter, and why? And what about the hardest markets? It's like a one question in 27 parts, I know. But.
Yeah, man, this, you can go on for why don't I have one of those little square TD things?
You can have mine. No offense, TD.
We talk about the BRIC countries, for instance, and just to elaborate a little bit on what John was saying, the good, the bad, and the ugly. You can take two approaches. One would be if you're just starting out exporting, you might say, well, don't start with Brazil. It's the most difficult. Start with a place like Vietnam, which is one of the easiest. Then again, you can say, well, if you can do it in Brazil, you can do it anywhere. One thing, and first of all, if you're making, some kind of cheap commodity or plastic toothbrushes, forget about it. Don't go. I would say don't go anywhere in the world because you can't be competitive. You have to have somewhat of a unique product or service. In Brazil, one of the biggest hurdles is the taxes, and they vary from state to state. I think Sao Paulo is the highest state tax, but then you've got the federal tax, and then you've got your import duties and your VAT taxes and everything else. The rule of thumb, this is hard to believe, the rule of thumb is add 100% to your cost to cover the taxes and duties and such.
Ouch.
So if you're trying to compete with a company that's producing this commodity product in country, it ain't going to happen, you know. When you look at and I guess still, you know, staying with the BRIC countries, let me say too with Brazil, given the fact that they've made tremendous progress in the last 10, 15, 20 years, you know, coming out of, you know, a very corrupt regime, extremely high inflation, yada, 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 and it's, what, about 45 million people now have overnight come from abject poverty into the middle class, hence the demand for products. But as the country is experiencing this tremendous, you know, growth spurt, soon to be the 5th largest economy in the world, I'm told that those taxes probably will start to be curtailed, which is a good thing for us. When you look at you know, we mentioned Argentina. I refuse to do business in Argentina. I've had a number of opportunities, which on the surface seem you know, pretty remarkable, but you know, it's just I'm not willing to deal with the political and social unrest and the corruption. Now there are other countries like Russia. Now our largest customer in Russia, or actually it's our largest customer, happens to be in Russia, but they're the largest taxpayer in Moscow, and as Julia has pointed out to me in the past, that doesn't mean anything because a lot of companies are not paying their fair share. But you know, they're a huge company, growing rapidly. There we have issues with documentation because you have customs officials, and it's accepted practice. You know, that's how they're making their money, is finding, you know, this T isn't crossed, this I isn't dotted, and so things are held up until money exchanges hands. And although, you know, I'm not paying that money, the customer, you know, the ultimate customer is paying it. You know, they're going to hold me responsible for it. So, you know, we're just very, very careful about all of the documentation, and it's critical. When we first started, you know, our very first shipment going into Russia many years ago, I would say we had 30 iterations of our invoice and our bill of lading and our price sheets that we had to keep sending over there to the customer, and then they would come back, and we would say at least 30 times before we could finally make that shipment. So it's those types of things. As we talk, you know, from one country to another, it's an entirely different set of problems. This customer in Russia, I will say this because I think it's critical, and it's nothing, you know, profound. You know, it's a practice that anyone in the U.S. would utilize with a good, you know, a good partner, a good customer, and that's establishing the personal ties. Now, this is you know, the owner of this particular company. He's a PhD physicist and a very brilliant businessman, and he's grown this company to you know, well over 1,000 employees in a relatively short period of time. We've become not just close business associates, but close friends. Him and his wife came over, what, 6 months or so ago, Deborah, and vacationed with us. We're going over there to Moscow, and I guess on July 8th for a week. And you know, the itinerary is not, you know, talking about pricing and strategies and such. Yeah, we'll do that for a little bit, but it's, you know, do you want to do the Bolshoi ballet this time, or you know, do you want to go wild boar hunting? I haven't decided yet. I think Deborah probably has made her decision. The boar hunting, yeah. But I mean, it's you know, it's developing that kind of close relationship where of I mean, just absolute trust. And when you can do that, I mean, you got it made. There are communication issues in any of these countries, even the ones where they speak perfect English. I have a horrible habit of using bad analogies and metaphors inappropriately, even amongst you, I would do that. But using sports analogies to someone in Russia is I'm going to hit this one out of the park. Well, that doesn't mean that's very confusing to them. So I've learned over the years, even with emails, writing it like I'm writing to a sixth grader, only because using the simplest terms that cannot be misinterpreted. Forget about impressing people with 50-cent words and using a thesaurus and such. Very, very basic language communications will do you well.
Thanks, Wayne. John, question for you. If you were to advise a small business on what they need to do, what they need to know about doing business in another country, what do you think are the 3 most important things that a business needs to know about doing business elsewhere?
Well, that's an interesting one because most of the way we've approached it, as I said, was sort of a one-on-one. I think the documentation is important, but what I would encourage is that if you have people overseas that want to buy your product, you find out who their export agent is, and you let them do all the documentation. And we try and do that, particularly when we're shipping distances, either small quantities or whatever, where the paperwork becomes more valuable than the actual product. Australia, we ship a fair amount to, mostly in the agricultural industry, but I would encourage the use of an intermediary for that kind of purpose, because it's for a small company that doesn't have somebody highly schooled in export and the paperwork. I think that has been one of the difficulties. Obviously, the expectations of in-plant dates, if you don't know how long it's going to take, if you miss a boat, for instance, it can be another 2 or 3 weeks. And we do business with companies that generally want their products, and if somebody screws up a delivery, it's got to go by air. And when you're making heavy metal components, where the half the value is in the material, obviously being on time with your deliveries is extremely important, and having very clear communications that way is. I think those are the main events. I've found doing business in Europe to be very easy. There are some situations in Italy. We ship a guy all prepaid freight. We actually contract with the shipper to drop it at his dock and let it be their problem. In the beginning, we would ship. He would have his agent arrange for the shipping from the ship, but then we found he was being charged an enormous price from the dock to from the port to his dock, and there was no way to control what the local Italian trucker was going to charge him. So there are things of that kind that you have to work through. We don't have a problem with payment because we have open account with every single customer, because our product is very unique, and because we serve OEMs. If they don't pay their bills, we don't give them any more product, and that's true with the big multinationals as well. I often will take that tack, reminding them that our terms are net 30, where we relax to 45, and we don't shut you off until you get to 60, but after that we won't ship you anymore. And I've never lost money with an overseas account. Into Mexico, it's cash in advance unless we know them personally. And some of the companies we do business with down there, the kids who are involved in the business have gone to prep school up in the Northeast, and you go down and you meet them, and you begin to trust them because they have a lot more understanding of our culture and so forth. But when we don't know a customer, in certain parts of the world, we generally we would make it cash in advance initially, and then from there we'd We just give them open account. They understand we have a good product, we have the best price for what it is, and with the world recognition and the tooling for doing a lot of the products that we do, really lock them in over time. So I found, again, to answer to the question of the three areas that I would advise somebody on, I think the paperwork, I think beginning to know some of the nuances, and then how you handle the money are going to be things that you've got to keep your eye on.
Okay. Thanks, John.
If I could just elaborate a little
Sure,
bit on that, I would certainly agree with everything that John said. It's important. Incoterms 2000, for anyone that's not familiar with that, it's sort of the Bible for international transactions, and it's good to have an in-house expert on Incoterms 2000. Buy the book. Deborah is our. If she wasn't here, I'd say I was the expert, but she's here, so she's our in-house expert. John mentioned, freight forwarding such. There's where your experts are to make, to sort of your policing before the shipment goes and getting everything in order. We happen to use Ocean Air out of Revere, right in Logan, actually. For all of our, we probably do more air freight than ocean freight, but they put everything in order for us. I mean, we do the best we can. We know what we're doing, but we rely on them to make sure that we've done everything properly, and then they finish up all the other documentation that's necessary. Credit terms are certainly something that are negotiated company by company, country to country. When I negotiated with two companies in Kazakhstan, again, the land of Borat, they misunderstood what I said, and ended up where every time they place an order now with us, they send the money along with it. So, regardless of lead times or anything else, that's the way to do business, let me tell you.
They were probably talking with somebody in Mexico.
Lastly, for those that are not, I think everyone's probably familiar with XM Bank, and I don't want to, say anything bad about XM Bank. It simply does not work for my needs in terms of, I generally don't deal with letters of credit, the Chinese are offended by certain things, like you're not trusting them when you talk about letters of credit or anything else. So, in that case there, we, try to make sure we get a certain percentage up front, which is going to cover our costs, in the event of some catastrophic event, and then, depending on the company, we will then get, prior to shipment, the balance, or give them, the 30-day terms. But with XM Bank, I spoke to them a number of years ago at the suggestion of my primary bank, and the problem there was you cannot be selective in the receivable, or your foreign receivables. So if I feel real comfortable with 90% of my foreign receivables, and yet this other 10%, this 10% of companies are, I'm a little sketchy. You can't say, please, insure this 10%. No, it's insure all or nothing is how it works. So for me, it's a relatively high percentage of those receivables that you have to pay to the XM Bank. And given the 10% risk, I said no. It's simply not worth it. It's too expensive for me to insure that money. And what's the reason for even doing it? If you think about 60%, probably even more today, of our revenues are coming from exports. Well, as you know, the banks will give, credit, generally it'll be, 50% of your inventory, or you can negotiate higher, which is I have. And then, X percent, 80% of your domestic receivables, and nothing out of hand. Well, that suddenly you've taken 60%. I've taken 60+% of my receivables and pushed them right out of the equation in terms of collateral for my line of credit. So it can be a little bit difficult. At the time, I think I had just been awarded the SBA Massachusetts Exporter of the Year, and I was the poster child for my bank's monthly newsletter, and at the same time they were ready to shut me off on the credit because of so I said, you can't be patting me on the back here and then turning the cash faucet off over here. So we renegotiated everything, and it came out fine. First they were the ones that brought in the XM Bank, and I poo-pooed them, but that was just to kind of elaborate on what John said about the three most important things in dealing with exports.
Thanks, Benny. We're going to go to Q&A later. We will go to Q&A later, but he's my boss, so you can ask a question.
Well, I just thought we'd start with it now. And my question was, Shaun laid out a case for a significant strengthening of the dollar over time. I think specifically you mentioned against the euro, but one would assume that would be against other currencies as well. My question is, so we've seen in the last year or two a re-strengthening of U.S. manufacturing. We've got a couple of U.S. manufacturers here on the panel. What do you see as a macro effect, and then in specific, the effect in your companies of a strengthening dollar over the next couple of years? And do you have does most U.S. manufacturing have such a unique product where there's some price protection, or does that really kind of threaten, what threat is that to sort of our export business in general and then in specific?
Yeah, well, for my product is very unique, and there's really four players in the world, and they're in the United States, although one of them being Tyco, and certainly have offshore facilities for manufacturing. So we're less sensitive to that issue, other than the fact we're less competitive, of course, as the dollar strengthens. And in some cases, if we're dealing with an agent, they may very well be making their money simply on the difference, between the currency, especially between the euro and the U.S. dollar. And I have refused to, speculate in that area. I've been encouraged a few times to, which I haven't done, is to, play around with that. But, frankly, that's just not a business that I'm, that's not my forte. I'm not even that great of a business person. A couple of Julia, how do I generally start off these discussions? You've been to at least 3 of my panels. I'll tell people right off the bat. You can say it. What do I say? What do I call myself? Yeah. I'll tell people I'm an idiot. Look, and I'm not being cavalier. I say it because if I can do it, anyone can do it. All right, it's finding the resources to backfill.
Is that the Idiot's Guide to Exporting that you wrote?
Yeah, that's not a bad idea. But I've learned an awful lot. Deborah is not an idiot, so I'm not going to put her in that category. She's one of the resources, but. Yeah, so that will have a negative impact on us, Peter, but not a huge. It's not going to really affect. Maybe margins will be impacted and other people will suffer, but otherwise, given the uniqueness of our products and the fact, we haven't talked about this, and here I am going off subject again, but for small to medium-sized businesses, we do have to establish. Our credibility and the perception of size and everything else. And of course, with today's e-commerce, the internet, et cetera, you know, a lot has to do with your website. You know, you can make yourself look as big as you want, you know, with the perception that you create on the website. But, you know, for us, you know, having our ISO 9001 gives us the worldwide credibility. And the need for the real value of my business are the domestic or the North American agency approvals, along with the approval, you know, the worldwide approvals in each and every country. That's really is what's cost prohibitive for you know, other competition these days, even if they could you know, create the unique products that we do have. So the point being that not only do we create the perception of being larger than perhaps we are, and even better than we are. I probably shouldn't say that, but you know, with all of those approvals and such, we're protected.
In answer to the question from our standpoint, as you would expect, the more commodity-like products are more subjected to currency swings. I don't think there's any question that when you have more competitors, obviously, particularly in the bearing industry, which is filled with multinational giants, where we're truly a niche player, but where we cross the boundary and have a little more commoditization of some of our product lines, there we run into a difficulty with the currency fluctuations. I'm not necessarily long-term optimistic about the strength of the U.S. dollar, only because I see our debt and so forth, and we and the Europeans are racing to the bottom, basically. That doesn't hurt us from the standpoint of the rising Chinese currency, and that has forced some of the imports pressure that we've suffered in the past to be blunted. Cost of freight and so forth, very real, and some large domestic manufacturers are beginning to calculate in their imports from China that quality has to be assured by somebody on the ground, which is costly, and there are some cost centers that they haven't factored in until recently. Air freight being one of them, because the middle market in China is getting so much stronger and sopping up capacity in China. There are other ramifications as well that we run into, but in Europe, on the commodity side, we do notice a dramatic difference. A few points of the dollar actually, in combination with the euro, actually makes quite a difference. On the more customized products, of which we try and do, because we're a niche player, we try and do that. The cost of selling is much higher. The cost of engineering, the time lag to get into those markets with tooling and all of that aspect, the relationships that you have to build. That insulates you, obviously, from currency fluctuations, because they're not going to spend $60,000 or $80,000 on tooling to make a particular one item if they've already got it tooled, a fluctuation. So therein lies the advantage of the customization a little bit and the uniqueness of a product. So wherever you can build that differentiation, it's marketing 101, obviously. Where you can build that in, it gives you a little more insulation from currency fluctuations.
Thanks, John. Shaun, question for you. Amid the economic problems in Europe, are there any opportunities, good opportunities for U.S. companies to do business there?
I think in Europe generally, you know, the economies that are growing well and probably have slightly better prospects from a longer-term point of view are probably the developing, what we still term the developing economies in Eastern Europe. I think, unfortunately, for the larger economies in Europe, you know, the scenario I've kind of laid out for those economies over the next little while does suggest fairly low growth and fairly subdued levels of activity generally. So I think within Europe, within the not quite Euro but borderline Euro area, it's the Eastern European economies that still look to have some potential for above average growth, I think, over the course of the next little while.
Well, what a difference 20 years could make. You had mentioned in your keynote about threats over the next economic threats coming up in Europe. What do you see as the biggest threats there over the next 18 months?
In the US?
In Europe?
Well, I think it will be the sort of gradual, potentially anyway, the gradual unraveling of the euro. You know, there are two trains of thought here that as we start to peel away some of the weaker currencies from the euro, you're left with eventually a rump, stronger euro. So if you're just left with a core group of stronger economies, the euro should be stronger. And I do have some sympathy with that view. But there is a process we're going to have to go through here to get to that point, and that process could be potentially somewhat destabilizing to get rid of there's no clean exit strategy, if you like, for countries that choose to opt out now of the euro. This thing was meant to be irrevocable, and if Greece, I think we'll see probably the next election in Greece is essentially a referendum on whether they stay in the euro or not. And if they choose to exit, that kind of calls into question the whole notion of irrevocable. So if one country leaves, I think the biggest fear for the Europeans is that Greece starts to pull out and actually makes a go of the recovery, because then that becomes somewhat more encouraging for the other countries to give up the euro and go their own way, with unemployment rates in excess of 30 or 50% for you know, the youth category. I think that is going to be quite a strong incentive potentially for those economies. So eventually we may get to a stronger euro, but I think that's some years away in this particular context. Structurally stronger euro, in other words. I think you know, the big problem if we do start to see countries pull out is that there is still a lot of for institutions and sovereigns, so countries, there is still a lot of cross-ownership within the banking system of sovereign debt within Europe. So banks own a lot of Spanish debt still. Some banks own still a lot of Greek debt, unbelievably. And so a sovereign withdrawing from the euro does get potentially quite messy for the banking system, and you know, we're still in a fairly fragile place from that point of view, which is going to be a bit of a hurdle, I think, for Europe to get over.
Thanks. John, Wayne, here's another jump ball question for you, another sports metaphor. How do you find a trustworthy partner to help you do business in another country?
I had a lot of difficulties early on before I discovered the resources that I mentioned earlier. I think, you know, again, by using especially the mass export, but as well, but the U.S. commercial services, their gold key service will vet candidates for you and identify the ones that will most suit your needs, and then even set up meetings for you to visit with them in the respective countries, and even go as far as setting up receptions at the U.S. Embassy. So if I had to do some of these over again, that would be it. We've you know, we certainly it was network. Using existing customers and their relationships or vendors, whatever, to identify some of our initial manufacturers, reps or agents, although we deal directly with OEMs in a lot of cases. But initially it was hit or miss, and we had a few misses. So I would strongly recommend the use of the you know, the U.S. commercial services for that.
John?
The way we've approached it, and again, that's probably the biggest challenge because of a customized product, but we're in the power transmission field, obviously, with bearings, and we know a number of other people, not only through our manufacturers' reps stateswide, but also we know a lot of the players, whether it's somebody else who makes drive lines or somebody who makes chain or whatever. And when they have a toehold overseas, I'm a director of a company in West Bend, Wisconsin, and they have a large enough footprint in Europe, for instance, so that if you can piggyback off their facility and tie into them, then you don't actually own the product. You can actually have them buy and resell, and then you get out from under the problem that I mentioned earlier, which was owning an employee or trying to put a tremendous amount of money into that. So that's been the way we've approached it when we've talked about representation overseas. But it still requires a lot of hand-holding because of the uniqueness of any customized product. So it's not really easy. I've never used government agencies. In some of my travels, I've contacted the consulates, and they're very friendly, and they tell you a lot about the culture and perhaps the economic forecasting for the country. But as far as actually doing the groundwork and interviewing people and having people who are knowledgeable in our particular markets, and you really have to do it by market. If you're selling the agricultural industry in the United States or in Europe or anywhere else for that matter, you've got to have people who are familiar with that equipment, and you've got to have people who have the relationships with those companies to give you entree. In Germany, you've got to speak German, and in France, you've got to speak French, and so on and so forth. So you need an organization that you can springboard off of. So often tapping into friends that you have in a similar industry is a good way to crack that. I have found in our business that working through distributors, of which there are many, for any kind of commodity, those guys tend to deal in the aftermarket, and I don't find that they're as aggressive when it comes to opening new markets and the one-on-one. So I haven't found using true distributors in your particular commodity to be as valuable as an OEM supplier. So.
Thanks, John. You both alluded to business customs and cultural norms in different countries. Are there particular, cultural nuances, business customs that you can shed some light on from particular countries that other companies should be aware of?
Well, the only one I run into is the Germans are very particular, but they don't stick to dates. They want you to engineer something and have it perfect, which is their reputation. But when it comes to meeting deadlines of various kinds, they're not particularly astute in that area as far as being exacting, except in their rail system. But overall, no, I haven't run into anything, but I don't get too far outside of my zone of comfort, which is generally Europe. It has been in Brazil and so forth, Australia, and but they tend to be pretty easy countries to sell into.
How about you, Wayne?
I guess the only ones I could think of really would be, and you tend to go online and do a little research, and there are a number of good websites that focus on business etiquette and social customs and such. Other than the Asia Pacific countries, particularly China, Japan, where certain colors mean certain things, and gifts are expected, and there's all very between bowing versus handshaking and all that, and of course at the same time some of these players are trying to do just the opposite, and so you're bowing while they're trying to shake your hand, and things like bumping heads, and but it's not a real big issue. We simply try to do the research so that we're prepared for for anything. At least we look like we know what we're doing.
Any particular sources out there that can really help you understand these customs before?
Yes, but I don't know what they are off the top of my head. I mean, they're really easy to do a Google search on, and foreign business etiquette or something. You pick it, you'll find it. I have one on my favorites that I refer to.
Okay. What long-term concerns do any of you have about your business in other countries? Specific to, let's say, Europe, China, Asia, Latin America.
I found that particularly in South America, there are expanding economies in the markets that we serve, and the cost of doing business, because of the nature of what you have to do, is going to stretch our comfort zone, as we've learned. I can do business with a number of the U.S. domestic manufacturers that have plants down there as a supplier and let them handle pretty much everything. But when it comes to really penetrating that, particularly the Brazilian market, which is extremely exciting, I think, for the future, not weighed down by the sovereign debt that the developed countries of Europe and the United States have, I see that as a wonderful opportunity, but I see the cost and the necessity to build an export awareness from a sales standpoint to be a challenge. Obviously, Argentina is a big market, but again, the political risk there so far has kept us out of there. And Eastern Europe is also a big market for us, the Ukraine. So we'll penetrate through the big manufacturers that are getting into those areas, and actually through Europe, where the European manufacturers are more familiar with doing business in Eastern Europe. We can, whether it's into Hungary or whatever, we can actually penetrate those markets a little more easily. But I do see that as the cost and the structure that you have to build as a small company, and gaining that expertise to penetrate those markets is important. I don't do business in Asia because they're very good at copying what you do, and we've got a freight factor. It's not a huge value-added kind of product. So we've kind of stayed away. We do ship China indirectly now through a customer, and I know it's just a matter of time before I lose that business. So I don't invest over there at all. So.
Wayne, anything to add?
Not really concerns, not with the nature of our products. I think people should obviously be concerned, particularly with China and with intellectual property protection and violations of international patent agreements. But for us, it's less of an issue, with protection we have through the approval agencies, and again, the nature of our product is not such that one can reverse engineer it.
Thanks. Well, enough of my questions. Now I'd like to turn this over to the audience, and it's time for your questions to the panelists. We have a... Yes, sir.
Actually, as a German importer, we purchase in euros. Question for Shaun would be, you had mentioned about Greece potentially leaving the European Union. If that was the case, would it set a precedent for the other indebted countries such as Spain and Portugal? And if that was to happen, what would be like a realistic timeline for these currencies to exit one currency and enter into a new currency?
It's a really good question. I think essentially we're just not sure at the moment. The euro was set up, as I said, as an irrevocable institution in a sense. So there is no planned exit for any country that chooses to opt out. In international law, unilaterally you can pretty much do anything you want, declare war, and any such activities that you choose to do as a sovereign country. So there's nothing realistically stopping Greece pulling out. There's just no clean way of it actually happening. So I'd imagine that the process is going to be potentially pretty quick after the next election, because if there is a vote by the Greek people that favours the non-reform parties, as we saw in the last election earlier in May, the pro-reform parties they couldn't get a majority. They didn't actually get a mandate either. They got less than a third of the vote. So the vast majority of the voting intentions went to the anti-reform parties. And I think if we get a repeat of that, then it's pretty clear what the rest of the Europeans, the donor countries, are saying. You can't stay in the euro and not have reform. So a vote against reform is essentially going to be a vote against the euro. That seems to be lost on the Greeks at the moment. The polls suggest that the vast majority of the Greek people want to stay in the euro, but they don't want reform, but the two are mutually incompatible at the moment. So a vote against reform is essentially going to be a vote out of the euro. What happens then, I think, is pretty unclear. It's going to be all about the money, as it usually is. The Greeks cannot finance themselves. They have a number of bond redemptions coming due over the course of this year, and more especially into 2014. So the timeline could potentially stretch out quite messily, but it will be about the money. They can't finance themselves when these bonds come due. And the reports that we have suggest to us that the Hellenic Republic essentially has about 1.5 billion euros cash in hand at the moment, which is not an awful lot. It will be about paying the bills. They can't pay the bills themselves at the moment. They're relying on donors to support that. If they don't vote for the euro, essentially they won't get that donor support from the European Central Bank, the IMF, and the other countries. And it will then be about the next default happening and where they go from there. I think the process will be essentially we'll wake up on a Monday morning and it will have happened. It will probably happen over a weekend. They will have to invoke a number of capital controls, declare a bank holiday. We've already seen a run on the banks. Essentially underway already. So I think it will happen over the weekend. They will have to introduce a number of capital controls. They can introduce, a sort of pseudo drachma until they get back to the new currency, whatever they, maybe one not ending in a vowel, but quite likely it will end in a vowel. We estimate that the initial devaluation will be at least 50%. To account for the inflation differential that's accumulated and the likely overshoot that we'll see in the markets as they reprice. I think the Greek drachma went into the euro at about 340 drachma to the ECU, as it was at the time. 340 to the Deutschmark. So that implies, if essentially a Deutschmark new drachma exchange rate of somewhere in the region of 800 is going to be the opening bid, and it's going to be very wide and woolly. It's going to be a very messy. We've never been here before. We've never done this kind of thing, at least in the modern era. So we just don't know what the process is going to be. I think it will be potentially quite messy. The Greek economy in and of itself is not significantly important. I think it's one of the Wall Street banks keep saying. China produces another Greece every 11 weeks. In terms of output. So we're not going to miss Greece in terms of its output, but the issue then is the financial mechanisms, the financial exposures. They've been reduced, and certainly banks have had an opportunity to write down and write off their exposures to Greece. Some banks still, institutions still have relatively significant institutions, but then it becomes, as I said, I think one of the concerns that the Europeans probably have at the moment is an unspoken concern is that Greece actually pulls out and makes a go of a recovery. A sharply reduced exchange rate of the kind of order that we would expect would be the equivalent, roughly speaking, of about a 10 percentage point cut in interest rates. It will be enormously stimulative for the Greek economy. So there is the potential there for Greece to pull out, and actually within a relatively short space of time. We saw it in Argentina after Argentina devalued. We saw it with Russia after Russia defaulted. There is the potential for these economies, once they're unencumbered by the obligations of the euro, to actually, or the previous financial regime, to actually make a bit of a go of the recovery. So within 2 or 3 years, Greece could actually be on a fairly strong recovery track, and I think that's one of the concerns that Europe has right now, is that if Greece pulls out and actually makes a go of the recovery, then the other hard-pressed countries are going to be strongly incented to do likewise. Then it gets a little more messy, because we haven't been able to write down the sovereign exposures to Portugal or Ireland. Portugal is a problem for Spain. If Spain becomes a problem, that's a problem for the global economy, not just Europe. UK exposure to Irish sovereign debt is pretty significant as well. So there's a number of, the cross relationships here within the financial system, the financial architecture is still pretty significant, and it's not going to be easy, I think, for the banks and the financial system to digest not just a Greek pullout, but the concern then that others will do likewise.
Thanks, Shaun. Other questions?
I have one. Perhaps you could just plunge your pen into my carotid artery, Shaun, while you're sitting there. I'm sorry, go ahead.
Other questions? Yes, sir.
I'm with the International Center of Worcester, and I have a question. Most of the discussion so far has been in the context of you as individual companies working overseas. But there's been a lot of discussion of economic clusters and sort of environment and the ecology of innovation. What do you see as the strengths and weaknesses of Worcester and the greater Worcester region as a platform or foundation from which to do global business? And is that even an important question?
It's an interesting question, one I have no answer for. I'm doing business out of Leominster, which I guess you're considering part of Worcester. I understand that. I can tout the advantages of Massachusetts, and that's part of my job as a board member with the Massachusetts Marketing Partnership. The advantages for doing business, my type of business in central Massachusetts, are more, having TIFs available, being able to, have a factory where it's $2.50 a square foot versus, $15, $20 a square foot as you get closer to either the 128 or Boston. It's just those type of cost considerations. Otherwise, there's no disadvantages, no support, or that I can think of. Certainly, I shouldn't say that. The workforce, the availability of particularly blue-collar workers the availability is significant in the the north central Mass area. Unfortunately, part of that is because of relatively high employment in that one sort of socioeconomic sector. And I guess transportation, we're access to major highways and airports, Worcester Airport not being one of them.
I've not done business from the standpoint of having manufacturing in the Midwest, which is a major portion of our market, but our costs are higher here for just about everything. Obviously, power is expensive. And where our margins are constantly under pressure from international sources as well as some domestic, although less domestic, it's a costly part of the world to do business in. Because of over the years, some of the basic skills have atrophied in the Northeast in manufacturing because it's moved out of this part of the country. Early on, we were a contract metal stamper that it was very regional, and as manufacturing left for first the South, then Mexico, then overseas, obviously it became less, there were fewer and fewer jobs. We were a capital and labor-intensive business at the time, and I could see no merit in that, particularly watching the things going down as far as our volume, and felt that we needed to change to get into something at least we could automate. But we've been extremely busy over the last 2 or 3 years with the resurgence of manufacturing in all of the United States, particularly in our market. And so finding people who are not only the skilled end, the engineering people, but also finding the CNC operators and people of that kind. We're growing a lot of our own. So I would love to see less taxes and allow us to keep the money and use it for training. I don't think that if government takes things away and then gives it back to you with things like incumbent workforce training, it's as beneficial, obviously. But I think that there are some disadvantages doing business here, and if I had more of a commodity product, I wouldn't be here. Certainly what's going on in Worcester is up for grabs at this point, a lot of discussion, I understand. going on. If taxes made the difference between our being here or not, I wouldn't be here. If I were to put up a 100,000 square foot plant in Worcester, it would cost me $30,000 more for taxes than it would in Auburn. So it doesn't take a whole lot of knowledge to figure out where you'd want to be or wouldn't want to be. I think Worcester, on the surface, is trying very hard to be a good home for, and I'm talking about Worcester because we have 3 plants in Worcester. It's trying very hard to be a good home for its businesses. But my sense is that the underlying attrition of business out of Worcester is a long-term problem that's systemic with the kind of government we have. And I'm not blaming anyone in particular. I think a strong mayor form of government would help. But our tax base here makes it difficult if you have a marginal business. And you can be out on the periphery very, so. There are a lot of good people looking for work that have to be retrained and come into the markets now that are evolving. When was the last time you used a travel agent? Doesn't mean that the people that got out of that business and lost their jobs aren't perfectly willing, capable, knowledgeable, hardworking people. They just don't have the skill sets for what is coming on stream here as a driver from a manufacturing standpoint. I don't have anything to do with biotech or medical devices, things of that kind. I'm talking basic manufacturing. So we've survived here because we're not going to get large, but our margins are probably better being a niche marketer. And I would have to, if I had more of a commodity, I'd be somewhere else.
Thanks, John. We have time for one more question. Yes.
Wendy Hughes from For International. Just to let you know, we provide services for translation and cultural training. If you ever have a need.
There you go.
Answer that question.
One more? Well, with that, I want to thank our panelists. It was a very informative discussion. And I'll turn it over to Peter.
Okay. So, terrific discussion. I have, in the tradition of doing business in Asia, we have 3 gifts. And I'm going to pick one person to shake their hand, the other one to bow down to, and the third one we'll do like maybe a Three Stooges kind of poke in the eye or something, I'm not sure. But we have a special gift of a Worcester book for Shaun, our keynote speaker, and for both of our panelists. Let's thank them again for a terrific, terrific presentation. Just want to thank again TD Bank for being our presenting sponsor, and for the other cooperating organizations, Ames International Business Council and the Mass Export Center. I do want to note that at each of your tables is a lovely, this is sort of to help us all go overseas. You can treat it as a wallet, but this is actually to hold your passport, a lovely little passport holder, and then with it, after getting off an 8-hour flight, either with your spouse or about to do business with someone, they have a wonderful companion gift, which is a breath mint. So when you get off the plane, you'll be fresh. But anyway, so thank you, TD Bank, for those lovely gifts as well. And we promised a 10:30 finish in the program. It is 10:25. We're 5 minutes early. Time to check in with each other. And thank you again to all our panelists. Thank you for coming this morning.